Here in this video, we will be going over a potential danger ahead for Tesla stock investors. This actually has to do with earnings coming out next week, Fed Jerome Powell, and the yield curve inversion. You could actually see the yield curve uninvert next week. What that usually means for markets is, well, not good. Tesla stock is already in a vulnerable position after falling over 25% just since the start of 2024. Any weakness here in the markets, well, could be bad news for Tesla stock. Now, first things first, before we get into anything that could potentially be bad for Tesla and or the broader markets for this upcoming week, I want to acknowledge again what I just said. Tesla stock has gotten utterly destroyed in 2024, and you're just a month into 2024. So any downside you see in the broader markets, I think Tesla would still feel some downside, but maybe not as much. For context, Tesla stock is massively outperformed the markets today, and I think that's a sign of what could be to come as long as we do not see more price cuts. In other words, I think Tesla stock is already preconditioned for bad news, and I think expectations are already very, very low. But that does not mean that we could not go lower, so we'll talk about where I expect Tesla stock could go if things do turn bad in the markets. Now, I wish I could say this is a hard prediction. It's a pretty easy prediction. The S&P 500 hit a new all-time high today, so what direction are we likely to go from here? Well, odds are it's probably down heading into volatility. And let me tell you right now, this week is probably going to be the most jam-packed, impactful weeks of all of 2024. I don't think it really gets this crazier than this in simpler terms. Next week, you are going to get a lot of earnings. You start off Monday with SoFi pre-market. Monday and after hours, you're going to get Super Micro. Super Micro is now the largest component of the Russell 2000. It is, you guessed it, a semiconductor. And it was a forgotten about stock for a long time. Became popular towards the, first almost second half of 2023, and it has went from $100 to almost $500 at the time of recording this video. What's notable is SMCI has rallied 70% in the month of January. Yes, in 2024, the stock is already up 70%. Same with Nvidia. Nvidia's up a lot. The whole semi-chip conductor is up big, and you're going to get a lot of earnings out of semiconductor companies this upcoming week. And if today or some of the earnings last night are any indication of what could happen, it is likely a pullback from here. I mean, take a look at Intel today, down 12%. So SMCI will be important Monday and after hours. Tuesday pre-market, you will get Pfizer, GM, UPS, JetBlue, Marathon, MSCI, HCA Healthcare, and the Pulte Group. Tuesday and after hours kicks off really your big tech names. You have Microsoft, Alphabet, Starbucks, Skyworks, and some other companies as well, like EA. You also have AMD. So you have Supermicro and AMD. That's going to affect the entire chip sector. It's either going to inflate this bubble, if you will, for 2024 even more, or it's going to potentially take a lot of air out of the bubble that we have seen in 2024 so far. Wednesday pre-market, you will get Boeing, Nordisk, Phillips 66, Roper Technologies, MasterCard, Thermo Fisher, and Boston Scientific. Wednesday and after hours, Qualcomm, Corteva, Align, Wolfspeed, Aflac, Century, MetLife, and Meritage Homes. Thursday pre-market, Altria, Royal Caribbean, Peloton, Enterprise Products Partners, Merrick, Sirius XM, Honeywell, Cardinal Health, Tractor Supply Co., and Stanley Black & Decker. Thursday and after hours, your big dog, Apple, Amazon, and Meta, that will all report earnings, as well as the Clorox Company, Skechers, Deckers Brands, and Microchip. And then Friday pre-market, couple different healthcare companies like Bristol Myers, AbbVie, Cigna, Regeneron. Then you'll have Charter and some energy names like ExxonMobil and Chevron. So this week is jam-packed of earnings. Think big tech and semiconductors. Now, NVIDIA does not report typically until a couple weeks from now. So NVIDIA is going to be the last, big, well-known name that will report earnings. But I mean, semiconductors are basically going to dictate how Nvidia trades from now until their earnings anyways, and I think that is a big theme of this upcoming week. Now, I cover this in almost every single video. It is the percentage of stocks above their 50-day moving average, currently at about 65.85%. You've actually come down in 2024. So the same time semiconductors are doing very well, big tech has done very well in 2024, the average stock has not. You've went from 86% of stocks above their 50-day moving average, which was December 27th, now to 66%. At one point, you hit a low of about 54%. So under the surface, stocks are not doing well. So what's going to happen is big tech names are either going to come down and match the broader markets. That's going to be bad for your index, potentially some downside for a stock like a Tesla, as well as a sympathy kind of move, an algorithmic kind of move, if you will, or your average stocks are going to catch up to your other big name players. Really, I think one of the big things next week could actually be the uninversion of the yield curve. Now, if you guys are unfamiliar with this, essentially the yield curve is this, the 10 and 2-year yield curve. Now, when this thing is normal, positive above the black line, that's normal, because typically if I were to, lend you $1 million for a month, right, I would expect a small interest rate. Small fee, essentially. If I were to lend that out to you for 10 years, I would expect a lot more. I would not expect to get paid more lending you money for a month compared to 10 years, right? That just doesn't even sound right, okay? So it's unnatural. The yield curve should not be inverted. This happens when the Fed raises rates in the short term and markets expect rates to go down in the longer term. So 10-year Treasuries, the Fed doesn't have as much influence on. 2-year Treasuries, they do. But it's ultimately bond investors that make that decision. Whether they want to buy the, 10-year and sell the 2-year, that's what is essentially happening when the yield curve is inverted. Now, when investors start to buy the 2-year, that's when you actually start to get the uninversion. So investors might start to buy the 2-year yield, 2-year Treasury in this upcoming week. Now, since 1950, since the yield curve has been invented, it has always predicted a recession. Now, markets don't need to worry when the yield curve is inverted. Normally, that's a pretty boom time. Normally, stocks are doing fine during this moment in time. Usually, you're not in a recession if the yield curve is negative. It's actually when the yield curve goes positive that you are either in a recession or shortly thereafter going to enter one. Now, again, back to bond markets and bond investors. The bond market is 3 to 5 times larger than the stock market on any given day or moment in time. It obviously depends on what's doing better. If stocks are doing really well, the bond market might be a smaller, percentage of the overall assets out there. But generally speaking, bond market much larger than the stock market. So when you think about it like this, experts in their fields, they're always going to communicate to the next guy up and the next guy up and the next guy up. So Warren Buffett or Jamie Dimon or president for that matter, they're going to have a lot more information than you do. So the yield curve is just showing you how people are moving their money. So if you start to see this uninvert next week, which is only inverted 14 basis points right now, it's been uninverting over the past, month or so, from inverted like half a percent in December at one of the lowest points, now to almost positive again. You are seeing investors going out and trying to hedge their portfolios, presumably because, well, we could be entering into a recession, and that's what the yield curve is telling you. I think this is a big risk out there, because if the yield curve is wrong, it's going to be the first time it's ever been wrong about predicting a recession. And, well, odds are markets are going to say, yeah, we're now positive on the yield curve. Maybe it is, after all, time to head into a recession. Now, the reason I believe the yield curve will uninvert is because we have the Fed meeting on January 31st. That is going to be Wednesday. So penciled between your semiconductor chips and SoFi on Monday, and then Microsoft, AMD, Alphabet, Starbucks on Tuesday, you're going to have the Fed on Wednesday. And then you're going to have Apple, Amazon, Meta, so on and so forth. So it's going to be a jam-packed week as far as that is concerned. But the Fed just did something very interesting that a lot of you guys probably didn't even realize. The Fed just ended their bank term funding program. Now, this program is essentially to bail out the banks that have a lot of bad bonds. Like if you look at the chart of TLT, for an example, let's say you're a Citibank. And Bank of America, they specifically did this, whereas JP Morgan did not. Say they bought bonds at $140 a pop. Bonds are now trading at $93, $94. Now, these are not going to be the exact dollar amount, but just for reference, they could be upside down 40% on their bonds. Now, if they have to fund their operations, if they have to sell those bonds, that's a problem. Well, essentially, Citi, Bank of America, these other banks, they went out and bought 10, 20-year bonds, locked in really low rates. So then when the Fed started raising rates, the bond prices started to fall as the rates went higher. Now, what the bank term funding program is let's say a Bank of America or Citi, they can say, hey, we have 10,000 of these bonds. We bought at $150 a piece. We know we're upside down. I know these are not worth $150 a piece right now, but I'll give these bonds to you, Jerome Powell. You give me the full value of them back. You just hold the bonds until maturity. And I can use the cash now as if, well, I didn't never take a loss on the bonds to begin with. Now, the Fed just announced on January 24th that they're going to end the bank term funding program on March 11th. This thing is being utilized at an all-time high right now. $161.5 billion is currently being utilized in the bank term funding program. Now, this means one thing in my personal opinion. This means coming this Wednesday on January 31st, the Fed is going to say we are no longer going to be selling our bonds. Because what the Fed is doing right now is they are selling $30 billion of mortgage-backed securities every month, or letting them run off of their balance sheet, and they are letting $60 billion of treasuries run off their balance sheet. If the Fed says we're done doing that, no more quantitative tightening, you know what's going to happen? Everyone is going to pile into 2-year bonds, shorter duration, and 10-year bonds. There's going to be a massive bid on bonds all around, and you will see an uninversion of the yield curve. Now, I find it interesting March 11th was the day that was picked because March 20th is the next Fed meeting. So what I imagine is going to happen, reading through the lines here, is January 31st, it's going to be announced of what the Fed is looking to do next. The Fed's going to say, here pretty soon, let's paraphrase, here pretty soon, we are going to stop running off our balance sheet. We are at a place of comfortability with our balance sheet, and we're going to end that pretty soon. Then the markets are going to sit here and say, well, they're probably going to end that by March 20th, and everyone's going to go out and buy the bonds. Yield curve is going to go positive again, and you're going to have recession fears in our markets. Now, recession fears, I think, would be easier to swallow if stocks were not at all-time highs, literally hitting a new all-time high today. Good news is, though, for next week, it's not like we're expecting the first rate cut in March anymore. Right now, it's still borderline, but we're technically not pricing in a rate cut anymore for March. 50.9% chance of a pause, 48.1% chance of a rate hike. So it's not going to be a huge blow to markets when the Fed says, yeah, we're not thinking about cutting rates in March yet, and signal maybe May or June. So on top of a majority of the market weighting of the S&P reporting earnings next week, on top of the Fed and the potential uninversion of the yield curve, let's be honest too, I think there's over a 50% chance the yield curve uninverts next week. And whether or not that starts the actual market downside, we'll have to wait and see. Typically, when the yield curve goes positive, you do start to see downside in our markets. Then when you actually go into the recession, then you get further downside. But for next week, if that was not enough, you're going to have quite a bit of economic data as well. On Tuesday, JOLTS job openings will be coming out. On Wednesday, as you can see here, you're going to get the Fed and the press conference. And then on Thursday, you are going to get let's see, ISM manufacturing PMI. A lot of funds and banks are looking forward to that to see is some of the weakness we're seeing in manufacturing indexes via some of the Fed, right? Atlanta Fed, New York Empire State Manufacturing, Dallas Fed, Kansas Fed. All their manufacturing index are basically plummeting. We want to see what the PMI says about that as well. And then on Friday, we will get, look at that, non-farm payrolls and the unemployment rate, in which will be coming out. So next week is going to be a very volatile week, and I do think, unfortunately, with all of the things that we have discussed here in this video, the odds are markets come down from here. That means odds are Tesla stock could also come down as well. Now, again, good news is you've probably felt a vast majority of the pain. Now, if we do see weakness in the markets, I think Tesla will massively outperform given the fall that you have already seen. And I do see a gap to fill. This gap was back here on April 20th when Tesla stock fell, and that gap to fill would be around $170 per share. Now, if things got really bad over the next month or two, you could fall to as low as $150 in my personal opinion, but I think the markets would at that point be seeing a 10+% pullback, so I'm not willing to exactly make that bet. I do think you're a lot closer to the bottom than not, but Tesla to fall to maybe 170, what would that be? Downside of let's see, about 6.8%. I think markets could fall 5%, if not more, to get Tesla stock down to 170, right? Now, there's obviously the potential outcome that the markets take all of this information as bullish. Maybe earnings come in a little bit better than expected. The economic data on Friday, especially non-farm payrolls, the unemployment rate signal we're not heading into a recession. Maybe the markets, don't take the yield curve on inverting as negative. There's always that possibility, but odds are upside is pretty dang limited here. And then when you're looking at stocks like SMCI, AMD, Nvidia, some of these other names that have to report earnings that have been largely carrying the markets higher in 2024 so far with all of this AI hopium, if you will, reporting earnings next week as well. Again, SMCI Monday and after hours, that's going to be a crazy earnings. Last earnings, they fell about 24%. And then you have AMD, which is also run up huge in 2024. I mean, I find it hard to believe those stocks go higher from here, at least in the shorter term. I think you're due for a pretty large pullback there. That's going to bring down basically everything, right? Everything's being somewhat grouped into the AI category right now. And you seen what happened last time the AI bubble was around during the summertime of 2023, you did end up pulling back about 10%. It was not that aggressive, about 10.5%. It did take a period of time from July through October, and maybe we're setting ourselves up for something similar to that in, Q1, Q2, before we ultimately start to go higher towards the election, and then what should be much higher following the election. But again, for whatever reason, if the markets love what we get next week, which I find pretty unlikely, Tesla stock could probably rally back to about 195. I think 195 is going to be a decent level of resistance. If things are really exciting, $200, 205 could definitely be in the cards as well. But again, as I said in the last video, it looks like something is changing for Tesla. It seems like investors are going back to the 2020, 2021 kind of outlook and mindset that Tesla is this long-term growth name that is more than likely going to revolutionize AI, real world AI, things that people can actually use that are going to possess massive amounts of value. And they're starting to look at Tesla in that light, not what Tesla's next quarter is going to look like or 2024 is going to look like, but more so looking for that next wave of growth, which I believe is going to come. So I think this does de-risk Tesla as well, to bad numbers, right? If people start to take a longer term outlook, and that's potentially where things start to accelerate towards the end of 2024, and Tesla stock still, in my opinion, could hit all-time highs. Let me know what you think about this information and what you think about next week as well down below in the comment section. If you guys would like to come trade some of these earnings like SMCI, I said it a couple times. I'm pretty excited. I have a trade on that one that seems to be playing out pretty well today. Couple other trades as well currently on our markets. If you guys want to come join the action over there, check out the link down below in the description of this video. In the meantime, enjoy the rest of your day, and I will see you in the next one.